Welcome back to another episode by the Dutch Investors. And today we're diving deep into long term investing, capital preservation, the mindset behind running a portfolio. Our guest is Dan Shuart, founder of Eagle Point Capital, and he is someone who thinks deeply about risks, resilience, and how to grow purchasing power over decades. He's written several very good letters, which we'll talk about all about in a second. Before starting Eagle Point, Dan was part of please correct me if I'm wrong, a private equity firm where he worked closely with portfolio companies from acquisition all the way through exit.
That's right. Yep, you got it. We can talk about that more in a bit, but yep, that's exactly right.
Awesome. Well, it sounds like the perfect guest to learn more about all these fascinating topics. So let's jump into the conversation. Dan, thanks so much for joining me. How about we start at the beginning?
Yeah.
What's the story behind Eagle Point Capital? What's the story behind you? Why did you start investing at all? And perhaps some background on who you are.
Yeah, that's great. No, thanks for having me on the show, and I'm looking forward to the conversation. It probably makes sense from a background standpoint to go back to kind of the college days. So I have a bit of a non-traditional background, when it comes to investing. I have an engineering degree from the University of Michigan. So I'm from Michigan, went to school at the University of Michigan, had a degree in industrial engineering. So kind of process focused and a lot of statistics and things like that. My senior year, late junior, early senior year, I kind of got introduced to investing. One of my uncles gave me Howard Marks's first book called The Most Important Thing. And that was kind of my first intro. I knew about the stock market and I had taken some accounting classes and things like that, but never had really thought too deeply about investing. And I read that book and it immediately just grabbed my attention. I couldn't put it down, and everything in it made sense to me. Kind of that whole value mindset of trying to buy things for less than they're worth. That made a lot of sense to me. The analytical piece was interesting to me as an engineer, the competitive piece, and just using it as a framework to learn about the world. The more and more I read about investing kind of in those early days, the more I liked it. And so I left college. I had already taken a job in industry, but I knew at some point I was going to be an investor full time because it's what I love to do. It didn't feel like it was work. It was interesting and fun and intellectually challenging. And so I knew that's what I wanted to do, eventually. I wasn't sure how, but I knew that's the field I was going to go into. So it was, that was kind of the very early days of how I got interested.
I would love to dive into the how. How do you start something like that? Most of our listeners are investors, mostly individual investors. They just invest their own money. So
yeah,
how do you start your own fund? How did you get started?
Yeah, so kind of even before we started, Eagle Point, just learning how to become an investor. I think there's really no other way other than just doing a lot of reading and a lot of practice, right? So you have to find an approach, and there's no one right approach for investing. You have to find the approach that works for you. Most importantly, that you can stick with for decades. Because as I'm sure we'll get into, that's the time horizon is the most important piece, of being a successful investor. Being able to stick with something over years and years and years when it works, and most importantly when it doesn't work, because no style works, every year, without fail. And so when I was kind of teaching myself what was going to work for me, it was really just about reading as much as I could. I read about everything from trading options to all the Buffett letters to all of Howard Marks's memos, Joel Greenblatt's books, anything I could get my hands on to figure out what was going to work for me. And then eventually you find a style that resonates with you that you can apply to the actual practice of investing. So there's a period of reading about investing, and then you transition to reading about businesses, and that's where the real work comes in, is trying to apply those concepts to stocks. And there's the only way that we know how to do that is by reading about them, reading 10Ks, reading transcripts, reports, newspapers, things like that. So that's kind of how the approach that we'll get into was formed. And then, so I spent time working as an engineer. I was an operational leader in a soft gel manufacturing plant, it's like a vitamin plant. And then eventually, I went to college with Matt Franz, who's co-owner of Eagle Point Capital. He actually started the business in 2017. and we reconnected kind of right before then, and realized that we wanted the same things. We both wanted to own an investment firm, and we had the same outlook on life, the same outlook in terms of our investment style, and wanted to run the company the same way. So we agreed to go into business together. I worked in private equity for a couple of years, kind of as a transition. It's kind of tough to go from being an engineer straight to managing capital. So it was a great transitionary period where worked for a couple of years with a private equity company doing lower middle market leverage buyouts here. Totally different style than we apply to the stock market, but learned a lot about the credit markets and how to really, the most important thing I learned was understanding business metrics and tracking what matters apart from the financials. What matters in terms of the business KPIs that you want to track and keep your eye on over the long run, and it helped me kind of cut through the noise, when we transitioned to public equities. So that's kind of the long-winded background of before Eagle Point Capital. Matt and I, decided to go into business together and registered the company in January of 2019. So we registered as an investment advisor. The way we're set up is we primarily manage separate accounts, so SMAs or separately managed accounts. The reason we chose that route as opposed to a blind pool fund initially was mainly ease of startup and access to a broad base of potential investors. We started very small, and we wanted to be able to open to the strategy to friends, family, really anyone that was interested in investing. And that gave us a great avenue to do so. And so that was kind of the early genesis of how we structured the company.
I'm not familiar with the two different options you have. What's the main difference?
So the vast majority of our accounts are just individual accounts that are each client, has access to their account. They can move capital in or out, though it's obviously a long-term, focus. And we manage all of those accounts pari passu. So they all own the same portfolio. We can trade them. When we make an investment, we can do it so everybody buys that stock in the same allocation.
I see.
At the same time, if we're buying a 10% position and someone has $1 million with us, they'll own $100,000 worth of that stock. If someone has $100,000 with us, they'll own $10,000 of that stock. We do have a small committed fund as well, where that's all the capital goes into one account, one vehicle, and that is invested alongside all the separately managed accounts. But we started with just separate accounts. Does that make sense? Yeah,
that makes sense. And do you invest your personal wealth in the fund as well, or is that separate?
Yep, that was one of the big things. Kind of one of the founding tenets of Matt and I's philosophy is having all of our capital alongside our clients. So we have 100% of our liquid net worth invested in the same portfolio as all of our investors. We just don't think it makes sense to buy a stock for somebody that we're managing their money that we don't buy for ourselves. And so all of our money, all of our family's money, our parents are retired, our siblings, aunts and uncles, all of that we're managing alongside our own capital. And so it creates a lot of pressure, but it creates a great dynamic because it forces you to really think about the downside protection first, because you're investing your family's money, you're investing your own money, and that's how it should be in our view, with money managers.
I agree. It aligns the incentives better.
Yeah.
So where did the name come from? Is it just a random name, or does it have a story behind it?
No, there's a little bit to it. Yeah, nothing too crazy, but so Matt's family has a family cottage on a lake just a couple hours south of where we are today, and there's a part of the lake called Eagle Point, and it's a nice scenic area, and so it's just kind of goes back to Matt's family, their family lake house.
Isn't it the national bird for the United States too, or?
I think so. Eagles are pretty cool, and it's definitely they're definitely the symbol for the kind of
freedom,
U.S. and stuff like that.
Capitalism, yeah.
I wish that was kind of the reason we chose it, but it happens to work out. But
you can always change the story later, right?
Exactly. Yeah, exactly. No one will know, right?
No one will know. We'll have to edit this out now. But anyway, one of the first things I noticed, I like to do some to check the background and the story and check the people's LinkedIn and the websites. And I went through, I would say, about 10 of your letters. And first of all, I really like the writing style. It feels very genuine. And I like something I like doing on the podcast is telling stories, and the way you're writing is kind of a bit of storytelling, which I really enjoy. So congrats on that. It's really nice.
Thank you.
One of the first things I noticed in the material is your focus on avoiding permanent capital loss.
Yep.
And that's a bit different from avoiding drawdowns. Can you walk us through what that means in practice? How does that show up in your investment decisions?
Yeah, no, that's a great question, and I think it is the most important piece of being a successful investor is avoiding big losers first, and then the winners tend to take care of themselves. And so the way we try to avoid permanent loss of capital in any given investment is we tend to focus heavily on free cash flow yield. And so if we find a business and it's returning a lot of cash to shareholders via share repurchases or dividends, and has minimal capex needs, it's very hard if you buy that stock at a high free cash flow yield. It's hard to lose money. So let's just say a good example is a British American Tobacco. We bought that stock last year. It was yielding about 10% at the time. They were doing some buybacks, trading for a kind of a mid single digit multiple of free cash flow. And unless you're wrong about the cash flow stream and the cash flow stream, ends up becoming impaired, that's a different scenario. If you're right about the earnings and you're getting a double digit percentage of those earnings back in relation to your purchase price every year, it's very hard to lose money in that scenario. The business has to really deteriorate, and it doesn't mean the stock can't get marked down to 5 times earnings, but then your capital return just goes up as a percentage of the new market cap. And so that's the first area of focus is cash flow generation, capital allocation, combined with a low purchase price gives you a very good starting point to not losing money over the long run. And the second piece is, like I mentioned, the business model. And so we focus on very simple businesses that we understand, that we believe we can predict with a high degree of confidence that we're going to be correct, at least in the ballpark, about what that cash flow stream is going to do over the next 5 to 10 years. And so those are the two things we focus on. And it doesn't mean we're always right. We will still lose money on occasion, but it's a good starting point. It gives you a good base rate for success.
I haven't talked to many fund managers, investors, business people that use the free cash flow yield. Why specifically that metric over other valuation metrics?
Yeah. It's because we try to think of every business, every stock, from a private owner mindset. And if anytime we're going to buy a stock, we ask ourselves, the first filter is, would we buy this business in whole, so 100% privately, if we had the money and the ability to do so? And if the answer is no, because either we don't understand it well enough, or it's not high quality enough, it's not predictable enough, it's not, or the price is too high, then we shouldn't buy any shares if we're not willing to own the whole thing. And if we were to own the whole thing as a private owner, our returns would match the free cash flow yield, because we would purchase the company, and then any free cash that was available to shareholders, we would distribute to ourselves, just like Berkshire Hathaway does when they buy a company in whole. Their returns match the cash flow stream that comes back to the owners. And so that's why we like to use that metric, in the public markets, because we are owners, we're just minority owners, and our returns should mirror the free cash flow yield plus the growth that we get.
Is there like a hurdle rate, or does it depend on each company?
Yeah, it depends a bit. I mean, our investment hurdle rate is we're looking for mid-teens returns when we buy a company or when we buy a stock. And so our forward return expectations have to be mid-teens or higher, with a pretty high degree of confidence in order for that to meet our hurdle rate. And then we tend to focus the most heavily, the heaviest component of our forward returns is yield, and so free cash flow yield. And typically a lot of that free cash flow is coming back to us via dividends and share repurchases. And then the next component is growth. And so we like businesses that grow. We're not unwilling to buy businesses that aren't growing or that are growing slowly. That doesn't bother us. But we do like to at least own businesses that we believe are going to grow at an inflation rate over time to kind of protect their margin profile. And so let's say we buy a company at a 10% free cash flow yield. We expect it to grow 5% a year, and we can talk more about how we define growth. But then your base business return is about 15%. And if you buy a business for 10 times and you think it's worth 15 to 20 times because of the growth profile over the long run and the characteristics of the business, then you're going to get a valuation re-rating on top of that, depending on when it happens. And so that's our framework.
You talked about Berkshire Hathaway.
Mm-hmm.
Warren Buffett has made basically all investment decisions over the last 60 years, say, although that changed a bit over the last couple of years, I think due to age, of course.
Yep.
So how does that work for you? I believe the three of you run the fund together. So how do you balance like decision making? I can imagine you're not always on the same page
Yeah.
when it comes to companies and making a decision.
Yeah, great. That's a great question. So Matt and I run the portfolio, so we make all of the investment decisions, and we have a really simple rule that we've been using, for the last 6 years since we started, and it's just any buy or sell decision has to be unanimous. And so if we don't both agree, and if it's not both obvious to us, if it's not obvious to the both of us, then it's probably not a good idea. It's not safe enough, and it's worked really well. And Matt and I, we've never had an argument. We certainly don't agree on every stock, or normally it's because we don't have exactly the same circle of competence. It's very close and overlaps quite a bit. But there's at the margins, I might be more comfortable with something, or Matt might be more comfortable with an industry than I am. And so we just leave those alone, and we've been able to find plenty of ideas that we both agree. And normally we talk every day. Normally when one of us finds something in Value Line or something that we've read, it's usually on the other one's list the same day we found, and then we know that it's probably a good thing to chase down, because we're both excited about it. So it's a simple rule. We just have to it has to be unanimous on a buy or a sell.
Yeah, makes sense. You don't have to swing at everything. So
No.
I mean that's a good balance. You also mentioned in the letters, I believe it was called maximizing purchasing power.
Yeah, that's right. Yep. So it's just a way we think of owning equities as a great way to offset inflation over time and generate excess growth above and beyond that. And so it's protecting capital and growing after inflation.
That makes sense. So I'd like to lean back on your private equity experience. What are some of the lessons you carried over from private equity into the public market? Is there anything the public markets could learn from the
Sure.
private equity firms, the way they analyze or manage companies?
Yeah, certainly. I think the biggest thing that public markets could take away from private markets is the focus on business, kind of long-term business metrics. So that's going to vary by company, but there's always some measure of volume and some measure of quality that you need to keep your eye on. And the businesses that we worked with, we didn't really worry about quarter to quarter like bottom line results. Obviously, those are important, but it was more about if we're tracking the right long-term metrics for the business, then the financials are going to be fine. And so it's probably not surprising to hear me say that the focus on a little bit longer term, and even private equity isn't nearly as long-term focused as like we run Eagle Point Capital, but they're at least looking 5, 6, 7 years out. Whereas a lot of public equity investors are looking, it seems like weeks into the future, but at most a quarter or two or a year. So the longer you can look out, the larger of a competitive advantage you have, and anybody can do that. It's just a mindset. So that's probably the biggest thing is because when you do own businesses in whole, you have to think about them as businesses, and you have to focus on the business metrics.
Since you started your fund, do you feel restrained sometimes by, when I talk about my investments, I can look 20, 30, 40 years into the future and feel very comfortable owning a company. I have no pressure to buy or to sell anything. I can imagine with the added pressure of having shareholders, I suppose it could kind of change the way you invest. Has it, or is it not that bad?
Yeah, it definitely could. And that depends on your investor base. We've been really lucky to have investors that kind of self-select into the strategy. And so they understand the mindset by and large and have had almost no questions during any sort of periods of market turbulence, because they get the approach. So if you have investors that are hounding you and are worried about why did our stocks go down today, and they're calling and disrupting kind of the investment process, it's going to be really hard to run a business that way. And that certainly happens to people. We've been fortunate just by way of the types of investors that we have to not have to kind of contend with that so far, but it's definitely a risk. So we try to be really mindful when we're bringing a new investor on that it's a good fit for us and a good fit for them, not just accepting capital from anyone. And we've said no, quite often to people that didn't feel were a good fit.
Okay, I'd like to talk about patience. I think in some of the letters you've talked about patience or sitting still, and investing often rewards those who kind of move fast, at least in the short term. Me personally, I tend to avoid all IPOs. I tend to
Mm-hmm.
avoid crypto, AI stocks, everything that gets talked about way too much online.
Yep.
But you've written about the value of sitting still, which I really liked. Sometimes I struggle with this because, I mean, news and social media is all around you. So, how do you personally stay calm and hold your position when there's so much noise? And to follow up on that, investing is about being contrarian. But I mean, if you're wrong, it doesn't matter. You were contrarian. So, how do you kind of balance that?
Yeah, I love that Howard Marks quote. He says it a lot. Is investing. You have to be different and you have to be right. Those are it's important. You can't forget about the second part of being right. I'll talk about your first piece of the question first in terms of how to be patient. I think the the most important thing is to one, understand the stocks that you own. If you understand the businesses behind those stocks, then you can be patient and take a long view if one of them isn't doing well. If the stock price is going down, you need to look to the business, not necessarily to the stock price, as to what to do. And so if you understand what to track, at a business level from your portfolio holdings, then you can look out, over the short-term noise. And
And does that include valuations for you personally?
yeah, absolutely. So
Okay.
yeah, I mean, valuation is really important. And if you've gotten the valuation right up front, you have a lot better chance of not having to contend with a big drawdown, right away, which inherently, no matter what, is going to make things harder. You can still deal with that, and it's still going to happen. But it's so that's why it's so important to we like to say you can't borrow conviction. You have to build it yourself, and so you have to do the work. You can't just buy a stock because someone else is convicted in it. You have to build the conviction within yourself in order to really hold through difficult periods, which are inevitable in the investment world. The other piece is structuring your portfolio in a way that allows you to be patient, and that to us is being quite concentrated. So we own usually around 10, 9 to 11 stocks at any given time, with the goal to hold them for a really long period of time. And if you know that you're only going to hold 9 to 11, it forces you to be really picky and really choosy and to be patient about making any changes to your portfolio because it's a high bar to activity. If you're going to put 10% of your net worth into something, you want to wait until there's an opportunity that's obviously, a fat pitch. And so by forcing yourself to be concentrated, it almost forces patience because you need to be very selective.
The thing I struggle most with, evaluation is such a weird thing where we value a company and you decide to either buy it or you don't. But the thing I find particularly difficult is when you have a company and you hear, what is it, don't cut the flowers or let your winners run and whatever the quotes may be. But at the same time, um, if you look at for example, I would love to own a company like Essilor Luxottica or
Yeah.
Netflix, which I missed after analyzing it.
Yep.
But at the same time, when I look at the valuation, I don't think I made a mistake. So when is the valuation so important that you sell, and when do you let the valuation just get out of hand? For example, Costco has been expensive for 25 years,
Yep.
and you could have sold 20 years ago,
Yeah.
and you missed, I don't even know how the gain it has now. So
Right.
how do you kind of think about that?
Yeah, it's a great question. It's something we think about a lot and don't always get right. Our framework for when to sell an investment because of valuation is if we believe the valuation gets to a point where it's going to the valuation multiple is likely to compress over the next 5 years enough that it will offset the business returns, and the returns from the stock therefore will likely be below our hurdle rate. So a really good example is Davita. We owned Davita for a number of years. We bought it kind of post COVID when they were so I don't know if you know what Davita is. It's a dialysis business. It's a duopoly in the dialysis space. So they treat end stage kidney disease. So it's a very niche business. It's a duopoly with Fresenius. They basically have the dominant between those two, almost all of the market in the U.S. and a little bit abroad. So it's a very necessary business. It's slow growth, but they do a ton of share repurchases. It kicks off a lot of cash. Berkshire Hathaway owns about 45% of the business. So, anyways, it kind of fits the style of business that we like. And we bought it in 2022, I believe it was, when it was very cheap. So, kind of, they had a lot of issues coming out of COVID. A lot of their patient base died during COVID, and so they had a kind of a reset of their patient base. And anyways, there were some scares with GLP-1s and what that might do to the rate of kidney disorders. And so we bought the stock. It was very cheap. It was a mid-single digit multiple of free cash flow. There was a lot of room for error. A lot had to go wrong to lose money at those prices. The stock did draw down a little bit further because you can never bottom ticket. But then it did well for the next couple of years. And so into early 2025, the valuation was no longer a mid-single digit multiple. It was more like mid to high teens. And so to us, given the growth profile of the business, we thought it was really likely that business was not worth a mid to high teens multiple. It was likely a low double digit fair multiple, because most of the returns came from yield. And as your valuation multiple goes up, your buyback yield goes down. So the forward returns as a function of the valuation compressed to a point that we thought we had better ideas, and so we sold it.
So opportunity costs come into play when valuation gets out of hand?
Yeah, 100%. Anytime we buy or sell, we're weighing against our next best idea, whether it's in the portfolio or out of the portfolio. And if we have positions that are in the portfolio that offer better returns than anything else outside of the portfolio, it doesn't make sense to make a change, just because of valuation. But we're very conscious of it.
Yeah, I think you, in one of the letters, you talked about, I think it was the fundamentals letter, where most positions get a 10% weighting, right?
That's right. Yep. So our goal is to purchase up to 10% of our cost in any position, and we try to get them all there. It doesn't always happen exactly.
Is that the maximum?
Yeah, we won't go over 10% of cost. We have several positions that are much larger than 10%, but that's because they've compounded up to that.
Exactly. Yeah.
Yeah, not because we have a strict rule not to double down, past that 10% level, because that's how we've seen, really good investors get in trouble. Because you're not going to be right every time, and if you continually double down and you end up being wrong, you can really impair your capital. But if you limit yourself to a 10% exposure, you've inherently limited your downside in any one investment. So it's part of the risk control of running a concentrated portfolio.
Is there a thing such as the right amount of activity in a portfolio? How do you think about the buy and sell frequency, or knowing when to act versus when to stay put?
Yeah, that's a great question. There's no right answer, or there's no target for any given year. For us, we found that about 20% or so turnover is pretty natural for us, but that's not because it's a target. It's because that's the cadence at which we've been able to find new investments. And there's no rhyme or reason. You can't predict when you're going to come across one, but that's generally a couple of times a year is when we've made changes to the portfolio, and it's all driven off of the opportunity set that we're seeing, not a goal that we have. And so when we find a new stock that the forward returns with a high degree of confidence exceed our lowest current holding in terms of forward returns, then that's when we make a change. So it's strictly driven off of the opportunity cost and the opportunities that we're seeing during periods of great market turbulence, like during COVID, during 2020, to some extent during the fall of 2022. We had heightened activity because we were seeing more opportunities, but it just depends on the opportunity flow that you're experiencing.
Can you give us some examples of companies you bought during the COVID crash?
Yeah, my favorite one that we bought, which we still own, is AutoZone. And so we had followed AutoZone for a long time leading up to that, and it got to a point where the stock got so cheap that Matt and I remember sitting on the phone talking about, because AutoZone's stores were closed for a brief period of time, and so the stock got really cheap because there was going to be no revenue, for some period, and we were actually looking at the financials saying, how long can this company go with no revenue? and we couldn't believe that we were asking ourselves this with a company like AutoZone, which has been one of the most steady and predictable businesses that we've ever studied. And we got comfortable that this company was not going to go out of business. The world was going to continue. It was going to come back online. If AutoZone was closed for so long with no revenue, then we had bigger problems in the world, and it probably wasn't going to matter anyways. And so that was we bought that one during the lows of 2020. And we still own it. It's a great business. It's not nearly as cheap as it was back then, but it's a phenomenal business that still has good prospects. So that's one example.
That has delivered a stellar return so far.
Yeah, that's a good one. We always joke that people are looking for the next AutoZone, and it's like AutoZone's been the next AutoZone for for a long time, and there's a long way to go with that one. So
yeah, it has a, well, pun intended, I guess, a long runway. But
exactly.
I'd love to talk a little bit more about decision making.
Mm-hmm.
In your most recent letter, I believe, from the fund, you talk about the psychological experiment from the 1950s on independent thinking, where, and I am quoting the letter here,
okay,
people often abandon their own judgment to align with group consensus, even when the group is clearly wrong. Which brings me to my question. How do you avoid falling for this yourself?
Yeah, I think what I mentioned earlier about not being able to borrow conviction from others, you have to keep that at the front of your mind always. And so if you I'll take like the semiconductor businesses, of recent years, we've read those reports, and I've read Nvidia's 10K. I've read a lot of those companies' 10Ks, and the stocks have done great. And sure, I wish that we would have been able to buy Nvidia because it's gone up so much. But at the same time, I don't regret not owning that stock at all, because I read the report and I don't understand how to predict where that business is going to be in 5 to 10 years. And so it's just not a fit for us. And so there's no envy, on our part that we don't own something that other people talk about a lot or that other people own, because we just don't understand it. And it comes back to that private owner mindset that if we don't understand the business well enough to own it for a decade, we just shouldn't buy any shares of it. And so you have to always keep that lens and understand that there's always something that you will understand, and there's enough opportunities out there that do fit your criteria, that it's okay if you don't own every stock that's done well. It's the same thing like you mentioned with Netflix. It's a great business. We've never owned it. We've admired it from afar because it's always been too optically expensive for us. I think we do understand the business well enough, but we don't regret not owning it because it just doesn't fit within the criteria that has worked well for us. And so that's okay. And other people can own it and make money off of it. And we'll make money off of other things. I think the other piece that really helps is having a partner. And so a lot of people, will run an investment firm kind of, largely as a one-man show, which is great. It's really helpful to have someone to talk to and to kind of have we give each other some guardrails to not stray and kind of go along with the herd. If you have a partner, I think it helps a lot.
I like that. I think Buffett became a better investor due to Munger as well.
Definitely.
So it makes sense.
Absolutely.
Yeah. I think you said you were on the merger and acquisition side, or am I wrong?
Yeah, I did both. So we did. I was on the mergers and acquisition side, and I also spent a lot of time with the existing portfolio. So working with kind of the management teams of the portfolio companies.
Okay.
Given my previous background in engineering and operations, I brought some of that lens, and so it was fun to be able to see both. And
I see.
Buying and selling companies is fun, and working with them is fun. So it was a flavor of both sides.
Well, we know that besides serial acquirers, most acquisitions fail or are capital destructive for shareholders. What makes a great acquisition in your eyes? And to Munger it, to invert it, what is something you look at that might be a red flag when it comes to acquisitions?
Yeah, I think the biggest thing is if there's no logical business fit to doing an acquisition, if it's not clear how this existing business fits within the business that's acquiring it, it's a major red flag. So if it's diversifying essentially or just unrelated, then it optically looks like the management team is acquiring just because they don't know what else to do with the capital and they want to continue to grow. And we'd rather have that capital come back to us as shareholders. If we owned a company like that. On the flip side, we owned Alimentation Couche-Tard, which is the owner of Circle K, and one of the largest, I think the second largest owner of convenience stores across the world. And we've studied that business for a long time. We owned it for a number of years, and they're the opposite. They are fantastic acquirers, and they have a very strict kind of playbook, both in terms of valuation and then integration. And
They wanted to buy 7-Eleven, right?
they've been trying to buy 7-Eleven, which I wouldn't be surprised if eventually they find a way to do it, but they haven't yet. But that's their playbook, is to buy. They do a lot of acquisitions of mom and pop and or small regional chains of convenience stores, and then integrate them into their infrastructure. And they're really good at sourcing fuel. Their gross profit per gallon is way higher than the rest of the industry, because their operational excellence is really strongly kind of rooted in their culture. And so those acquisitions, when you combine the ability for them to become more profitable as a part of Alimentation Couche-Tard and their willingness to not overpay in general, has worked out really well. And so they're a great example of a serial acquirer that has stayed in their circle of competence. They've not strayed too far. They tried to buy a grocery store. This was the one time, I think it was a French grocery chain. That was the one time when the market reacted negatively, because it didn't make a whole lot of sense. It wasn't totally different, but it didn't fit within their typical acquisition pattern. And the stock dropped. That's when we bought it, when it became evident they weren't going to make that acquisition. And then they kind of stopped going down that path. So they did stray for a little bit, but by and large they've stuck to their knitting, and it's worked out really well.
It's we actually our analyst Luke analyzed the company. I think late 2024, and I believe he owned it for a couple of months as well before deciding to sell. But the difference we realized after the analysis and after talking about it for hours, that the consumer in America and the way these gas stations work and the way consumers behave are so different than Europe. I mean, there is a supermarket here.
Yeah.
I would argue anyone in the Netherlands can go on a bike and there will be a supermarket nearby within 10 or 15 minutes. And so you don't need gas stations other than just to fill up the tank.
Right. Yes. It's so different.
And I believe Couche-Tard makes a lot of money from the stores itself, right?
They do. Yeah. So they are selling convenience, obviously, right, as a convenience store. And it's so different here. It's such a driving, kind of society, just because of the physical space, in the United States between cities and things like that, that they've just carved out a great niche and it's very profitable. You can sell candy bars at the convenience store for a higher margin than at the grocery store, because they're low, it's a low ticket item. And so people aren't going to mind if it's a couple cents higher. And so it's very profitable. And then they make a lot of money on the fuel side as well. And that's likely to continue for a long time, kind of regardless of what happens with electric vehicles.
Yeah, and besides, I mean, Europeans and especially Dutch people are very picky, and whenever the price is like 10 or 20 cents higher somewhere, they'll complain about it and don't buy it, out of principle.
Right. Yeah, we don't have quite the same amount of discernment for low ticket items, it seems like, in the U.S., for better or worse. Yeah, it's worked out well for Alimentation Couche-Tard and Dollar General and things like that.
If you had to make an educated guess, how far away is a supermarket for the average American?
It depends on kind of the type of supermarket, but if a lot of rural towns in America, and there are a lot of them, might be 20 minutes away, a 20-minute drive from a Walmart or another super center like that. If you live in the city, you're only a couple of miles away from a grocery store. But if your focus is more on serving the rural customer, kind of out in the country, that's not anywhere near a large city, you could easily be 30 minutes from the nearest grocery store.
Okay, it's not as bad as I would have guessed, but
it's not like you're an hour away, but it's certainly it's not like a lot of people in the U.S. can just pop over and be at a Walmart or a Kroger or a Costco.
Yeah, it's just something I've been thinking about lately. I might even do an episode or an article on it. But the difference between consumers, I mean, for example, one of my friends is going to analyze a Starbucks And the way consumers in Europe behave compared to the United States is just so different. The culture of getting a coffee in the morning or uh, grabbing some food at a Starbucks. Here, Starbucks is kind of like a luxury item almost, where you just get it every now and then, maybe every couple of weeks. You just get a coffee, and then
Mhm.
because it's expensive, and we just get our coffee from home.
Yeah.
Like I said, the gas station difference and the way it's just interesting to think about. Although we're all Western countries, the way consumers behave it's just fascinating to me.
I would love it if you do an episode on that. That would be one I'd love to listen to because it's something we think about a lot, and it's a reason that 80% of our investments are in the U.S. because we just understand the society more. We do have some investments in Europe that are primarily European focused, but it has to be things that really translate across borders in a predictable way, and there's not that many businesses that are like that.
Because actually is one of the reasons sometimes I don't invest in American companies, because I don't know how ingrained the company is into the culture and the way people behave with the company, and sometimes it makes me hesitant. For example, Portillo's is a great example. I think everything besides the pretty leveraged balance sheet is very interesting to me, but I just don't know how good the food is and how well the Chicago style food will translate into the rest of America, for example. I think this is just a prime example of why I am hesitant sometimes of American companies.
Yeah, I agree, and I actually agree with your thoughts. And I live in America on Portillo's. I've never been there, and I don't, I wouldn't be able to predict how well that's going to do outside of the core market. Obviously, they've got a great local brand or kind of regional brand, and who knows how that'll translate to to Texas and California and wherever else they end up opening. Maybe it works great and it does translate, but it's good. It's exactly the question to ask, and I'm not sure how to think about that.
You'll have to ask your partner and let me know.
I know he likes Portillo's. Yeah, he'll have to get his insights on it.
Yeah, definitely. In your letters, you talk about, and I've never heard these two words next to each other, strategic mediocrity. And it says merely good results with a focus on consistency and longevity. How do you do that, and how did you come up with it?
Yeah, that's been one of my favorite kind of one of my favorite insights that we've learned from others is you don't have to swing for the fences or you don't have to do extraordinary things to get extraordinary results if you're given enough time. And so the analogy we like to use, and you maybe you've seen this post, but is that of a snowball rolling down a hill. And so if your goal as an investor is to have as big of a snowball as possible at the end of the hill, you can either choose a hill that is very steep and you might get down the hill faster and it might pick up a lot of snow in the process, or you can choose a hill that's maybe a little bit less steep, but is very, very long and gives you a long time to pick up snow and make that snowball really large at the end of the hill. And the slope is your rate of return. So if you have a hill and of course, the best outcome is a steep slope and a long hill. But I've not seen, outside very rare outliers, those that have been able to generate, 25% returns for multi decades. They're out there. It's possible. It's been done. I'm not sure it's repeatable. So we've elected to say, we don't need to swing for the fences. We don't need to aim for 25% annual returns for 25 years. If you can generate, low to mid teens annual returns and sustain that for 2 decades to 25 years, the results are astounding at the end of the day. And so if you focus on not having disasters, and which by the way, a lot of times a company investments that you think are going to do 25-30% a year, there's usually risk with those, and you're at risk of impairing your capital, or as we like to think of it, your snowball flying off the hill. That's what you don't want to have happen. So if you focus on a narrower range of outcomes that are still good, and you can sustain that narrow range of outcomes that's above average for a very long period of time, you're going to have a really good result at the end of the day. And it keeps you out of trouble in the meantime. And so, for instance, if you can just earn, if you earn 13% for a couple of decades, you're going to make 20 times your money, and that's a good result, as opposed to maybe a higher rate of return for a shorter period of time with more risk.
You're basically saying we're not looking for that single needle in a haystack. We'll just look around the haystack and try and find um, all kinds of gold nuggets, which will do very, very well in the long run, instead of finding that one little thing that just does insanely well.
That's exactly right. And I like
It's not repeatable. The
repeatable.
other is not repeatable, right?
Exactly. I like to use the example of everybody knows Nick Sleep, and he's done so well, and it was a phenomenal, success story. But I tell people, don't try to become the next Nick Sleep, because he found Amazon and Costco and Berkshire Hathaway, and that was great, and it worked unbelievably well. And there's a reason that he earned such high returns. But he's the only one that found those three. And so if your goal is to become the next Nick Sleep, there's a lot of people that tried to become the next Nick Sleep that failed and blew up or had bad returns, right? Because it's arguably not repeatable, at least for the vast majority of people. And so we don't try to become the next that next Nick Sleep, because the outcomes can still be great without without aiming for finding the one company, the one next Amazon, because we just don't think our odds are very good of finding that. But we can find things that are going to do pretty well.
Walk us through your process from finding an idea. Where do you look for your ideas, and what needs to happen before buying or selling it?
Yeah, good question. So we our kind of top of the funnel idea generator is we read Value Line every week. So the Value Line review. I'm not sure if you've heard of it. It's been around since the early 1900s. More than 100 years, and it's an investment publication. Most people can get it free through the a library, with an online subscription, or you can pay for it. But what Value Line is it runs through about I think 2,500 companies per quarter, and then it repeats those every quarter. There's 100 to 125 companies per week in the issue, and it's one page per company, and they group it by industries. So you might have the airline industry, the bank industry, and oil and gas or something, in one given week. And there's a one-page review of each company that Value Line covers, and there's charts of the last 15 years of financials. So you can see sales, you can see share count, you can see return on capital, return on equity, debt levels. There's like 15 metrics and a chart that shows the stock price. And then there's a couple paragraphs about what's happened in that company over the last quarter since they last covered the company. And so we read that every week. And so if you're seeing a couple thousand pitches per quarter, and you see those same couple thousand pitches every quarter, you get to know a lot of companies pretty well. And there's usually in any given week, maybe 2 or 3, opportunities that jump out that look interesting because something's happened over the last quarter. The stock price has dropped, or the company's announced some, corporate transaction, or for whatever reason, there might be a handful that look interesting, and we'll take those. We'll read Value Line on Monday, and then you come out with a couple of things to do for the rest of the week. And so then you go and whatever companies look interesting, go read the latest 10K, go read the last couple of transcripts, and start to go down the rabbit hole. And of that funnel, a couple per year end up, becoming investments in the portfolio. But that's how it starts. And then we also find ideas from just reading the Wall Street Journal and reading Barron's and things like that. Reading other people's blogs, 13Fs, there's a whole variety of areas that you can get ideas from. But then usually the first place we go is Value Line. Go update ourselves on what's going on with the company, and then go to the company's filings and reports and presentations to build an understanding of the company.
Interesting. Never heard of it before. I don't really know what I think of it. It's kind of... I don't like looking at all... For example, a lot of people use screeners. I kind of have a love-hate relationship with it.
We don't.
Because everybody can see like the statistics and filter on high returns on invested capital and stuff like that. So you really need to do the work afterwards, right?
Yeah. I've not found any value in screeners, really. And with Value Line, and I think there's a reason, Charlie Munger has said a couple times the last thing he would give up is Value Line. And through the day he died, he still read Value Line every week. Him and Buffett will talk about it periodically if you listen to meetings.
So who write these pitches or these reviews?
So the Value Line review is just a company like Barron's or any investment research company.
Okay.
And they have analysts that follow these businesses, and we don't pay attention to the ratings that they give them, or they'll say which ones they think are timely or which ones are we don't pay attention to any of that. We just use it to
I see. I see.
keep up on the investment of stocks that are out there, or the universe of stocks that are out there. Um, and it helps us generate, initial ideas to go investigate further, from a primary point of view.
Oh, I see. I see. Yeah, it's the very beginning. So let's say you find something in value line, and you read about the business model, and you think it's interesting, and some of the metrics looks pretty good to you. What happens next?
Yep. So then we start to really try to dig into the numbers and understand what are the forward, rates of return for the business. And that, we kind of talked about it earlier, but our framework is yield plus growth plus change in valuation multiple. And so we have to build a bottoms up understanding of the business, as to what we think each of those components are going to be, in order to come up with what we think our prospective returns would be if we own the stock. And so yield is usually the easiest. Like I said, it's understanding the free cash flow of the business, the capital requirements of the business, how that will be sustained over time, and in relation to your purchase price. And so and how much of that cash are we going to get back, via capital allocation for share repurchases and dividends. It gives us a base, yield component of our forward returns. And then we look to growth. Usually growth is a function of how much capital the company can retain, and the return that they earn on that retained capital. So we call it incremental return on incremental capital. And so the product of that and the percentage of operating cash flow that's retained, that's going to be your growth component. That's how the business, that's how the intrinsic value should grow over a multi-year period. And so you have your yield, you have your growth, and then you have your valuation. And so valuation is the most fickle, piece of the equation. It's the most important over a 1 year period. It's not as important over 10-year periods if you're correct about the business. But we like to say, we like to buy businesses whose valuation multiple is more likely to go up than down. And how do we do that? We buy businesses for around 10 times our estimate of kind of, normalized free cash flow. And if it's a good business that's growing and you have a double-digit base return, the valuation is usually, it provides you a margin of safety, in case you're wrong. And we like less than 10 times, right? We'd rather buy, a mid-single digit free cash flow multiple. And we found a few of those recently. So,
Well, impressive. I mean, markets are pretty expensive from the looks of it. Do you talk with management before investing, or any qualitative research you do?
yeah, very infrequently. We have, before we've talked to investor relations and management before. We've not gotten a whole lot of value out of it, because, that they're going to tell you that it's a good business and that it's a good investment. But we prefer to look at the track record of management and what they actually do with the cash and the results that they've delivered.
Yeah.
And that's our and the proxies, right, of what are the incentives. That's important. But we don't spend a lot of time. We talk to other investors. We don't spend a lot of time talking to management. We think it's not the best use of our time.
Okay. And how long does the research process usually take?
It depends on the company, but because we're generally, we gravitate towards simpler businesses, we can usually, from the time that we really start digging in, it might be a couple of weeks, before we get comfortable with the business. Anytime we buy a stock, we make sure to write it up on our blog first, because we found that, if we can't communicate the thesis clearly and simply in writing, we don't understand it well enough, and there's something missing. Or we can't articulate, the risks well enough. So that's part of our process is do the research, write a blog about it, because we were doing this to ourselves, internally beforehand. We thought we might as well publish these blogs because we're already writing them. And then, then we might be ready to buy it.
Let's zoom out for a second. There is a lot going on. When we are recording this, there is all this stuff going on with Russia, Ukraine. You have I don't know if you like it, what I'm going to say, but you have a madman in the White House. You have the China-US relationship that is being put under pressure. You have Taiwan that is, I mean, there is so much going on. You have Israel, and what is your overall feeling? Does all of this matter for the stock market in a really long run? And do you have a feeling that the returns over the next decade will be better, worse, the same as before?
Yeah, I mean, as you probably gathered, we're not really macro people, and we don't ever make bets on what's going to happen in the macro. and have to be right about the macro in order for our investments to work. So what we do is we really focus on businesses that have as minimal of an impact, from a macro standpoint as possible, and that takes the form of royalty businesses, non-discretionary businesses, recurring revenue businesses, subscription businesses, things like that. That just, it doesn't really matter what interest rates are. It doesn't really matter what unemployment is. Broadly, right? There's some that are a little bit more cyclical than others in our portfolio, but we really try to focus on companies that control the majority of their inputs and outputs and have a limited impact of extrinsic factors, as possible. Every business, is to some degree affected by what's going on in the macro, but we just look to minimize it so we don't have to make predictions one way or the other. That being said, I think it's highly likely that the prospective returns for indexes are not as good over the next 10 years as they've been over the last 10 years, simply because they've done so well over the last 10 years. And at some point, the math doesn't work to continue, compounding at that rate for indices. But I have no idea. Maybe they will. It's happened before. The Japanese stock market went to an absurd multiple of earnings in the late 80s, and maybe that'll happen in the U.S. over the next 10 years. And if it happens, we're just going to keep doing what we're doing anyways, and we kind of ignore that noise. But you're right. There seems to be an unusual amount of volatility going on in the geopolitical landscape, and we realize we can't do anything about it. And so the only thing we can do is focus on finding businesses that should be minimally impacted, from all of that.
Let me be completely honest here. I have always appreciated and agreed with Buffett's saying of don't bet against America. But for the first time, I kind of feel like Trump has hurt trust so much that this might be the fuel that was needed for China and Europe to become less dependent on the United States of America. I don't know how much news you're getting from Europe, but Europe has said that they are looking for ways to become more independent and work more with China and less with America. They want to get kind of get rid of Microsoft. They want to get off the US cloud. They're incentivizing European companies like never before. And Europe has always been like a scattered bunch of little countries, but for the first time there's like unison. And I don't know, I think Trump might have really shot themselves in the foot for the first time, where China and Europe will start doing more themselves. And I mean, I can see a world where we are less dependent on America today than 10 years from now.
Yeah. I mean, I hope that's not, the outcome, because I would love to be, as close to our historical allies as we've been in the past. But I could see a scenario where you're right. It certainly is plausible, and it may have sounded crazy even a couple of years ago, but I don't think it sounds crazy, now. And I believe that's, it's definitely a possibility. And again, it comes back to, you have to be careful about what you own, knowing the risks of delinkage, of not just the U.S. and some European nations, but just all around the world. It just seems like that's kind of the trend, and you have to be aware of it. Again, I wouldn't make a bold prediction one way or the other and bet the outcome of my portfolio on it. But it's something at the margins that people need to be really thoughtful about. And it goes back to understanding the earnings power of the businesses that you own. What's the source of it? How sustainable is it?
Let's do some rapid fire, I like to call it. Let me ask you a couple of questions, and you just gotta give your gut feeling, your gut answer on it. And there's no wrong or right, but just out of curiosity.
Sure. Okay.
What is your favorite company in the world, valuation aside?
Favorite company in the world, valuation aside? I'm biased because we own it, but I love Brookfield Corporation. So they own Oak Tree Capital. It's an alternative asset manager.
Yeah, we know it. Yeah.
It's a royalty business. They invest in infrastructure. Yep. Brookfield. I love Brookfield. I also like the valuation, but the business model, it's one of my favorites.
So if you had to put all your funds money in a single company, that would be Brookfield, or?
Yeah, I'd be okay with Brookfield. There's a number in our portfolio that I would be okay with my entire portfolio in.
I see. What's your favorite CEO or who rather?
Well, I'd say, I don't know, he's not the CEO anymore, but I love Howard Marks. He's Buffett's the default answer for most people, and I love Buffett, but I just think the thoughtfulness of Howard Marks is, and the way he communicates, the way he talks about risk. He's the best, and so he's one of my heroes. And so he's the longtime leader of Oaktree.
Favorite brand in the world?
Right now, it would have to be Rolex because of we own a Rolex dealer, and I've learned a lot about the luxury space, and it's kind of amazing. There's a great book called The Luxury Strategy that I'd highly recommend for anybody that's studying that space, and to see the longevity of some of these luxury brands, Hermes, Rolex, it's phenomenal. Ferrari, it's just so powerful, and so one of those, I'd have to go with. Otherwise, Ferrari, yeah,
I don't know if you've checked out our podcast or our luxury industry report. It's one of the industries I am most fascinated about. So I think I've got like 4 deep dives into the luxury industry and a couple research report on several luxury companies. So if you're interested,
absolutely.
I'll make sure to share them with you after the episode.
Yeah, I'd love that. It's a fascinating space.
Pepsi or Coke?
Coke.
Coke?
Yep. I grew up with it, and I'm not a big Pepsi fan.
I see. I think you're a Buffett fan, so you can't really say anything else, right?
That's true. I did like Coke before I knew who Warren Buffett was, but it's only reinforced it.
I see. What's the hardest part of your job?
I think the ability to stay patient is always a challenge, and it's an intellectual challenging exercise to know that you're not going to have a lot of activity, throughout the course of a year. And so how do you deal with that? And so the blog has helped us a lot by writing and having a consistent output, even if we're not buying and selling every week. It feels like, it makes you feel like you're making progress, and it's a tangible, outcome that has helped us stay patient in managing the portfolio, because it's difficult. Even though we know it's the right way to behave, it still is challenging. And so that's probably the hardest.
What's an industry you'll never invest in?
I cannot see us investing in technological hardware that changes quickly, like semiconductors, but anything that can be rapidly displaced is just not something I see us ever owning.
So that includes ASML or Taiwan Semiconductor?
We've thought about Taiwan Semiconductor before and have become close. We understand that more than the primary kind of components, but it still is difficult because it's still, the capital intensity is unbelievable. And they do have a huge lead now, but I'm not sure it'll be like that in 10 years. Probably, but it's very hard to predict.
What's something you hope people will say about you as an investor 50 years from now? Let's say you you achieve what you want to achieve. Let's say you achieve 15% annualized returns for the next 40 years.
Yep.
What do you hope people say about you?
I'd like to hope that they learned how to look at the stock market, how to look at stocks in a rational way, and how to be very patient and to think for themselves. I'd like to, if that can rub off on people, that would be a good outcome.
Awesome. I always end with this question because I think it has a lot of value in it. If you had to leave our listeners with a single practical lesson about investing, something they can take with them in the long run, what would it be?
I mean, I mentioned it earlier, and I think it would be that you don't have to do extraordinary things to get extraordinary results, and you don't need to invest in the next Amazon or the next Nvidia to have an outstanding outcome. And so stick to businesses that you understand, stick to things that you would be happy to own in whole, and you're going to be okay. You don't need to swing for the fences. There's lots of opportunities out there that fit your personality, and everyone's personality is different. Everyone's, circle of competence is different. And I think the most important thing in investing is to stick to things that you understand. If I could tell people one thing, it would be stick to things that you understand.
I think that's very useful. I have nothing to add there. Dan, thank you so much for coming on the show, taking the time to do this. I really appreciate it. I know you're a busy man and there's a lot of other things you could do. So thank you so much. And I'm looking forward to reading all the future letters you're writing. I really enjoy them. where can people find you and learn more on the fund, or learn more on you, on the investing style you have?
Yeah, well, thanks for having me on. I had a great time talking with you and look forward to staying in touch. As far as getting a hold of us, our website is eaglepointcap.com, and my email is dan@eaglepointcap.com, and Matt's email is matt@eaglepointcap.com. So feel free to reach out. And we also have a Substack. If you just Google, Eagle Point Capital Substack, that's where we write. We have free articles. We have some premium articles. But we'd love for anyone to reach out and talk further.
It's a great Substack. I'll make sure to put all the information in the description and anywhere else we post this interview. Thank you so much, Dan, and I really hope to talk to you again sometime. There were a few things that I didn't know and learned about, which is why I love doing this so much. And let's stay in touch.
Yeah, I enjoyed the discussion. Would be happy to come on again at some point in the future. So thanks.
Awesome.